Welcome back to Finance News, where we're doing a UK-only special this week covering all of the goings-on from the spring statement, as well as all of the rest of the goings-on across the business and investing space. Unlike the Chancellor's announcements, this show doesn't need to be paid back in instalments. Sit back, relax, and let's get straight into your headlines. Rishi Sunak took to the Commons this week to outline changes to your pay packet in his spring statement. The Chancellor announced a raft of new and existing changes designed to help deal with the cost of living crisis as inflation takes hold here in the UK. Let's run through each of the big announcements one by one. First up, the national insurance increase of 1.25% is still going ahead in the new tax year from next month, which will see an increase in contributions from both employers and employees. The rate moves from 12% to 13%, and those affected will be anyone earning above £9,880, and those people earning above £50,270 will see that part of their earnings now be charged at 3.5% rather than the previous 2%. The big change comes from the increase in the allowance at the stage people are due to pay national insurance contributions, and from July onwards, this increases from £9,880 to £12,570, which is in line with the point where the basic rate of income tax threshold is. Someone on £30,000 a year will pay £53 less over the course of the 2022 tax year compared to the year before. However, those earning more than £34,261 will pay more. At £50,000 per year, you'll be paying an extra £197 extra. Furthermore, there'll also be income tax cuts, but this is not due to come in place until 2024, which does suggest that there might be a big event taking place that year, which could have something to do with general election. Who knows, that would be entirely cynical now, wouldn't it? Anyway, that reduces the income tax threshold from 20% to 19% for the basic rate of tax, which does affect the bills of most people and will have a saving, but that's for another day. Next up, fuel duty. With the rising cost of filling up at the pumps due to global oil prices increasing, the Chancellor has announced an immediate 5p cut on fuel duty for the next 12 months only. The move, which kicked in on Wednesday evening last week, is set to last until March of 2023 and is the largest we've seen cut to fuel duty rates ever. However, with the prices of fuel having risen already more than 30p a litre over the last few months, the 5p cut only takes the prices back to just over a week ago. That's according to comments from the RAC. They also added that the reduction in cost reduces the cost of filling up a typical family car by £3.30, which is probably the amount that a Greggs sausage roll will cost once they finish jacking up their prices. Further price cuts were announced to solar panel, heat pumps and insulation products, because that's the biggest issue people worry about here in the UK. VAT for this range of home energy products was cut completely, although it wasn't exactly costly in the first place, with the rate of VAT being only 5% compared with the usual 20% we're used to seeing on consumer goods. What great timing. I need to get some new insulation just in time for summer. That's how it works, right? And finally, the state pension increase is still going ahead, but at a reduced rate which breaks the triple lock guarantee. The increase is set to be 3.1%, which is significantly lower than the actual rate of consumer price inflation, which would have been above the 6% mark. The triple lock guarantee says that the state pension will increase either with inflation, earnings growth, or 2.5%, whichever one is the highest, but the government wanted to avoid a huge increase in their pensions liability, so have temporarily suspended the scheme to much criticism. Many expect it to be returned next tax year, but there have been no promises made so far. Moving on to some other news now, the Office of National Statistics released a report this week which looks at house price affordability in England and Wales from data in 2021. Their report found that full-time employees in England can now expect to pay 9.1 times their workplace annual earnings on purchasing a home, which is an increase from 7.9 times seen in 2020. Also, similar findings appeared in Wales, with 6.4 times annual earnings required to buy a home, another increase from 5.8 times just 12 months before. The report showed that the least affordable area of the country was Kensington and Chelsea in London, at a whopping 36.5 times earnings for the average dwelling, and the cheapest area in Copeland in North West, with a modest 2.7 times earnings per home. The report overall found that 91% of districts, house price growth outstripped the growth in earnings, and new homes also remained less affordable than existing builds. The EU strikes a gas deal with the US as it seeks to cut ties with Putin's Russia. The US President Joe Biden and the European Commission President Ursula von der Leyen announced the formation of a joint task force to boost energy security for Ukraine and the EU, ready for next winter. In a joint statement, the pair stated that the goals of the partnership would be to diversify to the liquid natural gas supplies in alignment with climate objectives and to reduce the demand for natural gas from Russia. The move comes after concerns that European nations are continuing to pour billions of dollars into Russia's war chest, as energy supplies from the former Soviet Union makes up a large part of the overall supply. The P&O ferry company sacked all of their staff this week over a Zoom call, which is the equivalent of dumping your teenage sweetheart by text message. Loyal staff of the company were terminated immediately in the shock announcement, putting 800 of them into redundancy. This week, P&O Ferry's boss, Peter Hebblethwaite, admitted to MPs that the decision to sack workers last week without notice did indeed break the law. He said there was no doubt that under UK employment law, the firm was required to consult unions before making the sackings. All staff were offered so-called enhanced packages of redundancy above statutory requirements, with some well-paid members set to receive over £100,000. The move sparked anger from MPs and government, with the chair of the Transport Committee, Hugh Merriman, urging the boss to resign. The company, which is owned by DP World, ultimately controlled by the government of Dubai and the United Arab Emirates, is looking to reduce costs and has confirmed that all staff are to be replaced by workers earning £5.50 an hour. Illegal under UK employment law, but in line with maritime standards, according to the company. The Transport Secretary Grant Shapps did say that the government is looking at ways to ensure fire and rehire events like this do not happen in the future. The war in Ukraine has knocked consumer confidence to a 16-month low. Consumer confidence fell by 5 points since February to reach -31 on the monthly barometer score as measured by market intelligence company GfK. The reading is the lowest since November 2020, when the UK entered into its second national lockdown. Consumers stated that they were less confident about their personal finances and the health of the wider economy after inflation hit a 30-year high last month and Russia's invasion into Ukraine rose the price of oil and gas prices. And finally, in our headlines, high street retailer Next announced some concerns this week and a stalling of its sales numbers. Lord Wolfson predicted that his selling prices would rise by 8% in the second half of the year and that profit guidance would be reduced by £10 million all the way down to the heady heights of £850 million in light of the Russian invasion into Ukraine. The results announcement still showed an £823 million pre-tax profit that was 10% higher than previous year, but only £1 million more than what was stated in January. The company is focusing on selling its homeware products and releasing new lines as the former catalogue-based business increases its online presence, selling its own brand and third parties. The share price sits around £63, down from the highs of £84 last year. And after all that gloomy news, I'm really sorry guys, I'll do my best to lighten things up next time. But for now, let's get straight to some of the best memes on Reddit's Wall Street Bets to end on a happier note and remind ourselves that there's many investors out there who have absolutely no clue what they're doing. Welcome to the best of the bets. With the recent stock market rally, we can all appreciate this video. If you change your broker portfolio screen to show changes for the week rather than overall losses or gains, you can feel like a champion and walk around like you own the place. Just pretend you never bought the stock at all-time highs, eh? The last few weeks have been pretty tough for investors, with one of the worst starts to the year in the stock market. I remember when people just told you to keep buying the dip. The problem is, once you've run out of money and it keeps dipping, when does it all end? Who knows? If the bad news is getting you down, don't worry, there's always some people out there to help cheer you up. This trader shows his Robinhood account making $659,000 on an options call with GameStop. Whether or not he's still down overall is another matter. Remember, the fastest way to become a millionaire is to inherit $1 billion and then lose it all day trading. And finally, as the Russian stock market opens, this is what happens when you don't allow short selling or foreign investors to unload their shares. Everything just goes up. Now, can we get this to happen for the S&P 500 or the FTSE 100? Maybe it will still work the same way if we ask nicely. Thanks for watching, drop me a like if you've enjoyed the video, subscribe for more, and we'll see you the same time next week for finance news. And as always, happy investing.